But what we're going to talk about today is 11 dumb, stupid things that people do to actually trigger an audit. These are red flags.
You know, we get a lot of people coming in for audits, and Pat George actually mentioned this morning right before we went live on the air, he mentioned that he saw a report yesterday that said that essentially, unless you're a big, corporation or extremely well off, you're very unlikely to be audited. And my kind of response to that was, well, yeah, but except for a bunch of stupid things that people do that are essentially going to trigger an audit almost every time. It would be like waving the red, cape in front of a bull and not expecting the bull to charge.
So let's dive into these 11 dumb things that people do to trigger an audit. These are some of the red flags that you'll get.
Now, I don't know how dumb this is, but it's certainly kind of a dumb mistake, if you will.
Some of these things on here are dumb. That's why I label them dumb. And so it wasn't Darrin. I'll take the heat for that.
And the first one would be, the wrong Social Security number. And it doesn't happen so often with taxpayers. It might happen if you were newlywed or whatever, and you had one spouse preparing the return, and the other spouse is not certainly totally dialed into what the new spouse's Social Security number is. I've been married for a long time, and I have to look hers up, every single time. But more commonly, it's the children.
But I bet Heather knows yours. I know my husband.
Absolutely does. But it's more common with the children because you want to take their deductions, right? And we've talked about this before. You can't deliver birth to a baby and get out of the hospital without a Social Security card anymore,
right.
Social Security number at least. And so that's pretty common. And I think I mentioned within the last few weeks I had a case where I was representing the father, and he was entitled to claim the children. He hadn't filed in a while, and he was estranged from his wife and kids, so they wouldn't give him the children's Social Security numbers. He didn't know what they were, and as I'm talking to him, I'm kind of like, how do you not know what your kids' Social Security numbers are? And he was like, well, I just don't.
Well, do you know your kids?
No,
I don't know my kids.
No, I don't by heart, but I know where to get the information.
I do too.
Within, moments.
But if you ask my husband where that was, he might not be able to find that.
Yeah, he's not really wired like that.
He's not wired like that.
So neither was this particular taxpayer. So after a lot of consternation and sort of scratching our heads, what we decided to do was we requested a very old tax return from the government, like sort of manually, and paid a small fee to get those. And lo and behold, the kids' Social Security numbers were on that old return, and voila, we had that fixed. But if you put the wrong Social Security number down on a tax return, guaranteed audit. Now, it's not
so it doesn't matter if it's yours or the kids.
No.
Any wrong social is a guaranteed audit?
Well, and we're using the term audit probably a little bit differently, okay? So audit doesn't mean always bring your box of papers and, come to the IRS office, or, the IRS is going to come to your home or business and we're going to sit down with your box of papers. It doesn't always mean
that. I guess we probably could have started there, because that's when most people think of an audit, that's probably what they think of.
And when I think about an audit, what I think about is an audit means that the IRS is looking at the return in order to propose a change, which means...
So they think there's a discrepancy, right?
Yeah, typically, almost never are they going to propose a smaller amount of tax or a smaller, tax bill. I don't think I've ever seen that. But they're going to propose...
So if they actually owe you money or the bill is less, they're going to skip your audit? Is that what you're saying?
Yeah, I don't think I've ever seen that. Although, I don't think it's necessarily impossible, but I don't think I've ever seen it, and I don't think I ever will. But it could be a letter of notice just saying, hey, you took this position on your tax return, and we disagree, and we have helpfully recalculated the math, and this is how much you owe. And if you agree, sign here, and if you disagree, then you have X amount of time to give us the paperwork,
And is that what they consider the correspondence audit that we talked about?
Right, that would be a correspondence audit, which is, different than an in-office audit or an on-site audit.
Does it actually say audit on the form, or how does that come labeled when they get it in the mail? What does it look like?
The minor stuff doesn't typically say audit, okay? It's just the Orwellian language is a proposed assessment.
Okay.
I say it's Orwellian because it's like government speak for we want to tag you, but we don't want to call it an audit. Versus if you have like an in-person type of audit, you're going to get a letter that says your return has been selected for audit. Congratulations. I'm being a little sarcastic here.
Well, I would imagine too, if the socials are in fact incorrect, that's probably because somebody had a typo, right? Like they're using the 10-digit keypad and maybe they hit a 6 instead of a 3.
It could be. It also could happen that, you switch tax preparers in a given year, and maybe the new tax preparer just didn't have it in the software yet, and he like you said, he keyed it in wrong.
So if your tax preparer is doing it, I guess one of the tips you could, like if you're pretty confident you're not going to get audited, you never get audited, but maybe you just change CPAs, this might be something to look at now that it's tax time and make sure all those socials are correct.
Which brings me to one of my pet peeves in life, okay, professionally, and that is that when taxpayers have their tax returns prepared, they are supposed to review them and agree with what is on the tax return and then sign that, or sign the document that says that you can e-file it. And nobody does. Nobody reviews the returns. Nobody understands the returns, which is a pretty good argument for, tax reform.
That's why we hire the CPAs, right?
How can a citizen comply with the law if they don't understand the barest fundamentals of the law? I think that's really unjust, and so I think tax reform would probably be a really good idea. But
that's coming too.
There's almost really not an excuse for you to review your return and check that the Social Security numbers are right.
That's easy. Yeah,
right?
That's an easy thing to fix. But when you, like for me, I don't even do my own bookkeeping. So literally the numbers go from one person to the accountant, and that's it. And if it looks high or low, he'll question it, and I'll go back and check it, and that's how I check my return.
And I think what you just described is better than most. At least you kind of look at it. A lot of these audits that I get, the people come in and I have them bring their return that's under audit, so that I want to be able to kind of figure out why they got selected for audit, because that's the issue, right? Usually one big issue, maybe two big issues, and then they throw in a half a dozen like minor issues.
Just because they found the big issue,
yeah,
right?
Just because they found the big issue. And so what does that tell you? That tells you try to avoid the big issue, because if you avoid the big issue, the 8 minor issues are not going to come up. You're going to get away with it.
And most of these big things are actually on our hit list of 11, wouldn't you say?
I think so. And I'm not trying to say, I just said something that I'm going to take back, okay? I'm not saying you should get away with it. That's not what I'm saying at all.
I didn't even hear that. It went right past me.
Okay, well, this is recorded, so we got to make sure that we fix it.
So today's show is all about 11 things that can actually trigger an audit. These are red flags. They're things you should watch out for. And we're talking about them today because we're right on time. We know a lot of you are still getting ready to file.
Remember, the corporate filing deadline is on March 15th. I can tell you for sure I will be filing extensions. I think I'm going to do that today, as a matter of fact.
Actually, I think I'm going to call my accountants because I think I'm almost ready, but that's a very good reminder for the rest of the month and the last few days. So stick around. Number 1 on our list was putting the wrong Social Security number for you or your dependents. We'll be back in just a minute.
We're going to have to hurry up.
With the other 10. That was right on time, Bad George.
Welcome back to the IRS Solution Attorney Show. I am the IRS Solution Attorney, Darrin T. Mish.
And I'm your co-host, Katrina Madewell, and today has been a great show so far, and it's going to be so fun. Like, I'm energized with this show.
So we're talking about 11 audit red flags because we're coming up on the filing deadline on April 15th. The corporate filing deadline is March the 15th. If you have not filed your extension yet for the corporate deadline, you want to go ahead and do that now. That'd be a great idea. If you're going to go ahead and file an extension by mail, you want to make sure you do it by a certified mail and keep the return receipt. That will be a $500 mistake if you don't.
Ouch! You're talking about maybe a couple $100 to mail it with certified mail? I mean, a couple dollars?
Yeah, $6.
Compared to $500.
Yeah, $6, give or take.
That's what I was mixing up.
One time I had a dispute with the IRS, and they disputed that I had sent the extension in on time. And the lady was kind of snotty on the phone. She said, well, do you have that green slip for the certified? And I said, as a matter of fact, I do. I sent it to her. It saved me over $500. It saved me 100 years worth of certified mail.
So you're going to love this question, but I have to ask it. So you got your, let's say it's, you go through the drive-through post office, you're dropping it off at midnight, right? Because you know how they're collecting mail to all the wee hours.
Right.
So you can't send it certified at that point, but you want to get it in the mail. So you're going to YouTube yourself and post it on social media or YouTube. It's timestamped. You can see it made payable to, is it U.S. Treasury, right? Not IRS.
Yeah.
And you're dropping it in the bin. And then let's say they challenged and didn't get it on time. Can you go back to that video? That's timestamped?
This is why I have a co-host, to make sure that she comes up with these wild, crazy solutions or scenarios.
Okay, listen,
I don't know.
You might think that's wild and crazy, and please answer the question, but let me tell you something. And I don't do any property management, but I have helped people with tenant location. And so one of the things that we do that property managers don't even do is we will video the property before somebody moves in. It matches the walkthrough checklist, and it gets uploaded to YouTube, so it's timestamped. So guess what happens when the tenant moves out? If the house is all jacked up, and it doesn't match. You've got something stamped.
So I'm
dated.
a real practical guy, so I'm going to give you the practical answer, okay? I think you probably lose. Now,
Really?
if this was...
You're an attorney. You're supposed to say, I'll argue that.
Well, I'm getting
there? Okay.
I think you probably lose because, you know, the amount of controversy is like $500, right? So are you going to go, if you lose, you're going to take that to court?
$500.
Probably not.
But if it's something bigger,
now, if you had to go to court, I think certainly you could win that for sure, because you would have some, you know, some evidence, some really pretty good evidence that you know, mailed it on time. There's something called the mailbox rule that lawyers follow, and it's in the, you know, the rules of civil procedure, that an item that was mailed is deemed received as of the date of the mailing. Now, the problem comes into place is, well, when was it mailed? Now, you could say, well, if there's a nice clear postmark on the envelope, that's pretty determinative, right? Of course, who has a copy of that? The person who's saying that it wasn't mailed on time.
Well, if it's metered mail, you take a picture, you could have it.
Well, that's true, except, what's the exception to that? Well, you can manipulate the date on the metered mail, so that
Can you
doesn't
still
really
do
count.
that?
Yeah,
You can do that.
well, I have one of those postage meters where you get it prints out the little thermal labels, you know, and you stick it on there, and there's no date on there, so who knows? But
People are selling the post-dated stamp, or the pre-dated stamp from the black market. I'm just kidding. Oh, yeah, I would say that.
anyway, we gotta get off of this topic.
I
We have a lot of
know.
other
Let's
stuff.
go.
Item number 2 is, if you just have a big mouth, you might get audited. And what
Does that mean?
What do I mean by that? Well, yeah, that definitely is, but
Not in that context.
not in that context. So what I mean here is having a big mouth is if you're taking, you know, questionable or just outright incorrect, you know, tax positions on your business tax return, for example, and you're out at the bar and you're bragging to your buddies, hey, I don't pay any taxes. Like, I don't have to pay those guys. I do this, I do that, I do the next thing. Well, that's a really bad idea, and here's why. There is an IRS whistleblower statute that says that if they rat you out, if they turn you in, they get paid.
Really?
Yeah, so probably not a great idea.
What do they get paid? Just out of curiosity.
It's a percentage of the recovery.
Wow.
So there's an incentive for people to rat you out. So you probably don't want to be, if you are doing something nefarious, which I don't think you should do, but if you are, keep it to yourself.
At least don't be dumb and tell everybody about it.
Also, a really common place for the IRS to find these big, you know, sort of schemes that are inside of tax returns and whatnot is former spouses. So you might not even want to have a big mouth to, you know, your spouse about these crazy things you're doing because, number one, you're sort of inculcating, you know, you're sort of really making them a conspirator or co-conspirator, but also because, you know, things don't go right and you end up in divorce court.
You know what they say about secrets? The more people you tell them, less likely it is a secret.
I get called quite a bit from people who, you know, want me to be involved in their whistleblower, you know, sort of situation, and I just refuse as a matter of principle because I don't think it's fair or right for me to be, you know, representing one side at one time and one side on the other time, even though those kinds of cases can be really quite lucrative.
So our Facebook followers, I'm going to try to read these posts as we go, but Richard says the former spouses always want to report the bad stuff. He was pretty right on time.
Yeah, he knows a thing or two about family law, I think. So he's absolutely right that the former spouse always wants to.
It's actually kind of fun when you think about the fact that we're live on air, but we're streaming also on Facebook. And I know a lot of your friends are attorneys, so they're going to add a nice little spin to that, and then I'll just mix it all up.
Yeah, we'll just go ahead and bleep out all the swear words as they type it. So the third one would be, you know, this is kind of somewhat common, and that would be exaggerating charitable donations.
So I know I asked you this during the break, and it's pretty right on time for number 3. And I said, well, what's the rule of thumb? Like, what is a huge charitable donation, and what is considered a reasonable charitable donation?
Okay, so anything that's over $250 requires documentation. So you need a receipt. So,
okay.
I'm not going to put you on the spot, so I'm not going to ask you the question. But
Yeah,
I noticed a number of years ago at the churches, instead of, you know, before this law changed, and it's, I don't know how long it's been, 10, 15 years, something like that, where they required documentation for over $250. At the churches, you would just drop cash in the collection plate, and at the end of the year, you'd sort of just kind of gather a number out of thin air, and that would be the number you put on your Schedule A, and that's what your charitable donations would be. And then at some point in time, the law changed, and they started giving you these little envelopes with a little statement on there so that the church could keep track of where everybody was, you know, who was contributing what, and then they give you a statement at the end of the year, hey, you contributed X. Which is always sort of embarrassing because it's nowhere near 5 or 10%, and even though it should be.
Time's supposed to be 10?
Yeah, so, you know, trying, but not necessarily always getting there. So I would say just as far as the percentage that you wanted to ask, is just like look at it Okay, if you make $30,000 gross, and your charitable donations are $15,000.
Yeah, that's ridiculous,
That's silly,
of course.
right?
But is it really that extreme?
Also,
do you really see that?
Well, I'm just gave you a crazy example, okay? But what if you're just barely getting by and you see these huge charitable donations? I think probably 10%.
But wait, what's barely getting by? Well, I mean, give me some numbers. Like,
Okay, so
hypothetical.
family of four, $50,000, and their charitable donations are $9,000.
Okay.
It's pretty high. Like, how do you even live on
That's a bit.
$41,000 with a family of four? You know, if you live in a really low cost area of the country, it might fly. And I'm not saying you would get audited. I'm just saying it looks funny.
So the other question, and this of course came to my mind, and then Richard asked it as well, is what if Goodwill gives me that blank receipt and lets me fill out whatever I want? Because that happens all the time.
Yeah, it reminds me of taxi cab drivers, right? They hand you their card, and that's supposed to be their receipt, and you're supposed to write those in. What do I do? Well, actually, you can look it up. We used to have books for this, but you can actually Google the cost of, or the value of, you know, each shirt you donated, each pair of pants,
Right.
each sport coat.
So
and then basically what you do is you would then fill that out, and then that would be your receipt. Would the IRS take it if you're audited? I don't know. It depends. I'm not sure. Yeah, taking pictures of the stuff you donated ahead of time would be awesome. That'd be perfect. I'd totally slay them on that. But, you know, would they take that receipt? I don't think I would walk in there and volunteer. Hey, they gave me a blank one and I wrote it down.
So we were using that scenario, like $9,000, your total household income's $50,000. When you think of tenth, you know, tithe, a tenth, typically, right, is what the Bible says. So I would imagine for IRS rule, it would make common sense that it would be at that 10% mark or less, right? I mean, that might not be exact, but does that make sense?
Yeah, I don't think the IRS is very likely to audit you if you're tithing 10%, you know.
Or less, right?
Or less to your church. Now, if it got up higher, a lot higher, then they might. But, you know, who knows? But this is all a guessing game.
Yeah, because again, these formulas you don't have.
No, they're all
right?
top secret. The government has algorithms to you know, help determine. But most of the things I see are just common sense.
All right, so we'll be back in a minute with the rest of the items that will trigger an audit. So anyway, today's show is all about 11 red flag audit triggers.
So the first three we talked about was, you know, using the wrong social security number. The second was having just a big mouth, telling all your friends or your family even that you've been taking, you know, questionable tax positions on your tax returns. The third is exaggerating your charitable contributions. You know, if you make $30,000, you don't want to write down that you're donating $15,000, especially if you don't have proof. If you do have proof, you're going to have really good proof because you're going to get audited, in my opinion,
and it should
with
make
that
sense.
ratio. Number four would be, what if you didn't file your returns at all? Well, you're going to get, you have a very high likelihood of eventually being audited because the IRS is going to prepare something called a substitute for return for you, which
How can they audit you if they prepared it?
Well, it's technically an audit. What they do is they gather up all of the sources of income that they know about, and they just add them up, and then they divide that by the tax rate, and then they crank out a tax return, and that's called a substitute for return, and that is, in fact, an audit. So you have a right to dispute that. That's why it's important that we call it an audit, because you have a right to dispute that in the future. But it's an audit of sorts.
That's interesting, that, you know, how there's so many different variations of an audit.
Yeah, there's a whole bunch of them. And remember, the way I would define an audit is when the IRS is, you know, examining the return and proposing, actually just examining the return. Examining any position on the return is an audit, in my opinion. So examining it means special. You know,
It's a challenge, right?
special.
Essentially, an audit is a challenge for anything?
Yeah, it would be a challenge to a position that you've taken on a tax return.
Okay. So the next one is Schedule C. So let's talk about what a Schedule C is for the
Man, we could talk about this for a very long time, but a Schedule C filer is somebody who is a sole proprietor, which means they have not elected to form an LLC, which is not necessarily technically correct, but basically somebody who is not elected to be taxed as a corporation or a partnership is by definition a sole proprietor. A sole proprietor is just like, you know,
They're going to itemize, but they don't have a company they're doing it through?
yeah, let's say you were an independent real estate agent or even an independent real estate broker, and you were just Katrina Real Estate, right? And you didn't incorporate or anything like that, you're going to use a Schedule C. And
Which I think most agents probably do that.
They
a
do.
lot of agents do not have a corporation or LLC. They're just getting paid, you know, by their broker, and they would itemize.
They do, and the Schedule C is the most commonly audited form on a tax return because it's used by definition by the least sophisticated people.
So
That
it
makes
gets
sense?
audited because of that?
Yeah, like think about it. Who's going to make more mistakes? Somebody who's taking the time to form a corporation and do this extra stuff ahead of time, or somebody who's like, yeah, I get paid, on a 1099, and I put all my expenses on a Schedule C on my Form 1040. So that's the theory.
I mean, unfortunately, most real estate agents are not like me, so I can see a lot of them doing that.
Yeah, probably most. I'd say that it's a very high majority. And
I mean, if you've worked with a lot of real estate people, are they filing Schedule Cs without corporations or LLCs? Is
almost
that kind of what you
exclusively.
see?
Almost
Okay.
exclusively. And the problem with the Schedule C is it's one of the most commonly audited returns. I want to say the audit rate's around 5%.
Now, why is that? Are they putting too much stuff on there? Is it all wrong? Like, what do you think triggers that audit?
Well, you see an awful lot of self-prepared Schedule Cs too.
Okay.
Okay, and so people are using my favorite software, TurboTax or something like that, right? And it has a running total and tells you how much you owe or how much you're getting back depending on where you are in the process of preparing the returns, which I think encourages mistakes. It's like, they're like, wow, if I click that button, I get $5,000 back. If I click that button, I owe $5,000. When I click the button that gives me money back.
So it kind of shows you the bottom line, and people can play and manipulate the numbers as they go, and that can trigger an audit?
Yeah, well, yeah, because you're not paying attention to the answers of the questions.
Yeah.
You're paying attention to the size of your return, right, or your refund.
Why do they even show you that until you're all the way done?
I don't know.
That would make sense.
I don't know. It's a gimmick thing. It's designed to get people fired
to
up,
pay for
I
it,
guess.
yeah.
But, so let's get back to Schedule C filing. It's the most commonly audited return, and the reason is all of your revenue goes on it, and then all of your business expenses go on it. And it's just one of those things that there's a lot of errors. They know statistically from years and years of data that a Schedule C filer is going to have more errors and it's going to generate them more money than a corporate filer. And so I've got a funny example. They have a tendency to trigger or to target cash businesses. One of the examples is a pizza parlor or liquor store, say. So I had a case where I represented a guy that owned a liquor store, and he got a 1099-K at the end of the year, which was for the gross amount of all the merchant card processing, all the credit cards, debit cards, all that stuff. And the position he took on a Schedule C was that was the total revenue for the business. Now, what's wrong with that?
Well, there's cash. There's
Right,
not only
right.
credit card receipts.
Right, so his position, without him even really knowing it, was there was no cash taken into this business during the course of an entire year. In a liquor store? Are you kidding me?
In a liquor store where, people, yeah.
And then it got even better, that when the IRS summons the records for his, the purchase invoices for the liquor, for the product, right? Those were paid in cash.
Ouch.
So that was kind of like an interesting
So
scenario.
I run a cashless business, but I'm
Right.
going to pay cash for my alcohol that I'm going to sell.
We actually got that audit settled, and we got a pretty good result considering those facts, because those are pretty scary facts in a way. I mean, so
Now they look
don't
at
do
bank
that.
statements too, right? At that
Oh,
point, they're going to look
absolutely.
to see what you're funneling through there.
Absolutely. So they're going to look at bank statements and whatnot too, and see what's really going on. And then you also, for Schedule Cs, you have to watch out for hobby businesses. So let me give you an example. The classic example: horse farm.
What?
That's a classic hobby business. It's like, we have a couple horses. I actually don't have any horses, but I'm saying in this scenario, we have a couple horses, and we let the neighborhood kids come over to have some lessons every so often, and we make $500 a month in lessons, and the horses cost $1,000 a month, so we're going to try and write off the losses of this horse farm because it's really a hobby. So the IRS is going to slice through that pretty quickly in that example and say, no, this is really a hobby, we're not going to give you.
Yeah, because
those
likely
losses.
they have income on that return from somewhere else, right?
Oh, yeah, almost.
I mean-
yeah, almost all the time, because horses are really, really expensive. People think
So,
that
in
horses.
that case, shouldn't you just do a separate LLC? Like, wouldn't that make more sense? And then carry those losses over to your return?
I
Because
think
we're
my
talking about
advice.
how to not get audited.
I think my advice in that scenario would be just be less aggressive on the expenses.
Okay.
Make sure there's a profit. Because I believe the rule is you're supposed to have a profit 3 out of 7 years. Don't quote me on that. It's close. Might
Okay.
be 2. Not
So if
really
you're
sure.
doing loss after loss after loss, they're going, wait a minute, why are you still in business?
Yeah, if you're piling up losses, really in any endeavor, if you're just piling up losses year over year over year, you're eventually probably going to be audited, because they're going to be like, come on in and show us what's going on here, because this doesn't make any sense.
We're going to give you some business lessons from the
You
IRS.
probably don't want to be taking your business lessons from the IRS. That's just me.
But that would make sense, that they would audit you if you have a loss year after year.
Yeah, so number 6 on our list here is if you've been audited in the past, you're a little bit more likely to be audited in the future. And why is that?
Now, isn't that just sounds unfair? Like, if you've already been audited, they're just going to have you on the radar now to audit you again?
We've been doing the show so long that I almost could have said exactly what you just said, predicting that's what you would say.
Who knows how my brain works at this point?
I would submit that it is unfair if in future years, after the first audit, that if you're not taking the same positions that got audited in the
Okay,
past.
so if you're not doing the same thing.
If you're not doing the same thing, it's really unfair.
Okay.
But if you're doing the same thing, don't you have it
Stupid
coming?
is, a stupid does, and it just keeps going.
Don't you have it coming? So if you claimed, a ridiculous amount of mileage, for example, and you got tagged on that, and then you do it again 5 years later, and then they bring you in for an audit, and you still don't have documentation, and you still have these ridiculous positions, I mean, I'm not
Well, you would
sympathetic to
think
the
after
government,
they
but don't you have it coming? at
Yeah,
that point?
but when they go through an audit, don't they usually learn by that point, or these are your customers? Basically, maybe the answer, right?
Have you ever had to learn a hard lesson more than once?
Yes.
Yes, I have too.
I have.
So that's what happens. I'm not putting anybody down here. There's
But
times
is it
when...
back to back, like the same year, or
Not
does it skip a
usually.
year? Okay.
Let's say they were audited for 12 and 13, and then it could happen they got audited for 14, 15. It could happen. But usually, I don't know, usually there's a couple of years intervening or whatnot. Because remember, they don't have the manpower that they've had in the past.
Now, if they pull you in for an audit, let's say for last year they're auditing 2015, how likely is it they're just going to go ahead and audit everything around it? So 14, 16, other years.
They're pretty much limited to auditing 3 years.
But if they drag one in, they're likely going to drag 3 in? That's what I'm asking.
No, it's really common. So
that's likely going to be the case.
people often come in with the audit letter on 1 year, and I'm like, well, this is going to... Did you do the same
The other
thing
ones are
on the year
coming.
before and the year after? And they're like, yeah. Okay, well, then...
We got 3.
Okay, we got 3. The other thing...
So what do you do in that scenario? Are you amending the other returns to try to fix whatever they jacked up?
You can't. Once it's under audit, you can't amend it. Now,
Even though
sometimes-
they only audited that year? Like, can you amend the other years?
I
Like,
guess.
let's say they bring the return in and you go, oh, here's where your dumb mistake is, let's fix this, and we know they're likely gonna audit the other years around it. Can you amend those returns before the IRS gets them? Because we talked about this before the show, once the audit starts, it's gonna cost you more money.
I believe the answer would be yes, but in practical terms,
It doesn't happen like that?
Usually what happens is the other years get brought into the audit so quickly, you don't really have a
There's no
chance.
chance, okay.
Or you explain what you just said to the client, and you're like, really, we should go ahead and fix this on this other year that's, could be subject to audit. Do you want to do that? No. That's the answer you get.
So are they afraid that it's gonna just stir things up?
No, they're afraid they don't want to pay any more tax.
They don't want to do anything, okay.
Got
it.
They don't want to pay any more tax. And
Yeah,
really
but how
what
much
happens-
more is it gonna cost them by avoiding it? Like, they don't wanna pay any more tax. Sure, nobody wants to pay more tax than they have to, but if they're already under subject for audit for 1 year, and those other years are probably coming because they did the same thing, like, how much more is that gonna cost
Probably
them?
going to save you at least 25% by amending, being proactive and amending.
That's a pretty big number.
Don't take this wrong. I'm in the pain relief business, I don't sell prevention.
Right.
If I was in the prevention business, I wouldn't have these folks as clients.
no
They
job.
only come to me for pain relief.
Yeah.
I would love to help them with pain prevention. I would love that. That would be very rewarding to me.
Well, sometimes
But-
you do. Sometimes these people come and they're a hot mess, and then
True.
you actually do fix them, so
Well,
they
true.
don't come
But it's
back.
like future pain prevention, really, is what
Right.
we're doing there. I'd like to help more people before they got into, hot messes with the IRS, but that's not really.
So our next one, I'm going to give you guys a little teaser going into the break because it's always a hot topic, but the home office. The home office, we've talked about this so many times, many times. This is going to be an audit for a red flag for an audit, and we're going to give you some guidelines that Darrin pulled right from the IRS site that will help you if you have an IRS, to help you from getting audited. But if you have a home office or any of these things, tune in, or if you know someone that does, because we may be able to help you avoid an audit. We're listening to the IRS Solution Attorney Show with Darrin Mish, and I'm your co-host Katrina Madewell. We'll be back in just a minute.
Welcome back to the IRS Solution Attorney Show. I'm Darrin T. Mitch, the IRS Solution Attorney.
And I'm your co-host Katrina Madewell, and today we're talking all about flags to trigger an audit. We got 11 of them we have been telling you about.
This is true, and we don't really have time to recap the prior 6, but the 7th is home office deduction. This comes up all the time. I've fought this issue a couple times on audits successfully. It's actually kind of a hard issue to defend because there's a bunch of really technical sort of requirements for the home office, but what we really want to talk about today was just be reasonable on your home office deduction. So a good example would be, let's say you have a 2,000 square foot house. Probably doesn't make sense that 500 square feet of your house is being deducted as a home office. If it is, and it could legitimately be, then let's say it's your garage. that could be possible, right?
That's about the right square footage.
Right, that's about the right square footage. So if you're going to take that position, then you're going to want to have really good documentation. You're going to want to have photos, and you're going to want to have very clear receipts and whatnot so that you can demonstrate that the entire garage, there's no car in the garage, there's no lawn tools in the garage, there's no, unless you're running a lawn business, there's, you know, let's say you're running a photo studio out of your garage. There better only be photo studio stuff in that garage. There better not be, like, literally a television in there unless the television gets used during the photo shoots. Because if there is, then they're going to say, well, that's not exclusively for the use of the business, therefore we're going to disallow it. So.
Wow, I'm just thinking about that. Like how many, I mean, it's not uncommon to even have a TV in your office just for background.
Maybe TV was a bad example. So another example would be you're cleaning a bedroom for a home office. There better not be a bed in there.
Gotcha.
Because if there's a bed in there and it's really the guest room,
yeah,
you know, then you're going to lose that because it's not exclusively used for business.
And I love how on the IRS site it says simplified options.
Yeah. So there's basically what's called a safe harbor or a simplified option, and there's a couple, you know, things. You're really going to have to look this up because we don't have time to go through it here today in particular. But they basically have if your square footage doesn't exceed 300 square feet of your house, then they're not going to look at it as hard. And if you take the standard $5 per square foot, you know, then as opposed to a higher amount, then they're not going to look at it too hard, that kind of thing.
I'm looking at this on the site going, yeah, safe harbor is kind of a good word. Like I think if you were to stay within these parameters, you'd be a lot less likely to get audited.
Yeah, and you know, but don't be lulled into this 300 square feet. You know, if your house is 900 square feet and you're taking 300, then that's not all that safe. Right? But
I'm saying, like, legitimately measure your office. Legitimately, that's your office space that you're using. What is that square footage? Take that.
Better than measuring. Take the square footage that's on, like, the property appraiser's website here in Florida.
And use that?
And just use that. Because that's what they're going to use. They're not coming to the house to measure. And your measurements could be off, or maybe in reality,
I'll just tell you,
maybe in reality the room is actually a different size than the property appraiser has.
Yeah, 80% of what the property appraiser has is wrong. Either the bedroom bathroom count will be wrong, the measurement will be wrong, something will be wrong.
But take the public records is what I'm saying, or maybe the site plan, maybe the blueprint of the house.
But that was my point. Like if the IRS is looking at that, hence. Instead of measuring it, use what public records has.
Take the one that's bigger. I didn't say that. I take the actual measurement, but the one that you can prove.
Yes, the one that makes sense that will not get you audited. So home office, be very, very careful with that one. Number 8 on our list. You gotta love this. If you're rich.
If you're rich, you have a much higher chance of being audited than if you're poor. And this actually sort of makes sense, okay? So like, why run around auditing a bunch of poor people who are not gonna be able to pay? But that's, you know, if you're rich, then there's much more likelihood that the IRS is gonna find, you know, if they find a 1% change or 1% discrepancy on a $5 million income return, then, you know.
Yes, and not that I want to go down this rabbit hole, but like when the elections were happening and a lot of people were saying, well, Donald Trump's returns have been audited like every year.
And that's why.
Like,
that's why. I mean, if the guy, I don't know what his income is, nobody knows, right? But let's assume that it's in the hundreds of millions or even potentially a billion. Well, tiny errors or tiny aggressive positions in his return are going to generate big dollars. So here, I have the stats right here that says, while the IRS audits only 1% of taxpayers overall, those odds rose to 7% for people with income between $1 million and $5 million, and about 21% for $5 million to $10 million, and 30% for people earning over $10 million. Wow. So what does that mean? That means if you make over $10 million, every 3 years you're going to get popped. You're going to get audited. But
it means the IRS needs money and you're a target.
Well, here's the good news. If you earn over $10 million, you can afford to have basically a full-time accounting staff that is documenting everything, and the audit may not be all that big of a deal.
Exactly. All right, so the next one, foreign assets.
Foreign assets. So I don't have a whole lot of time here either, but if you have foreign assets, if you have a bank account in a foreign country,
which you have to report on
you have to report using a form called an F-bar, and you don't do that, you are going to get caught and you may go to prison.
How will they know?
It's an audit of sorts. How will they know? It's a great question. Remember when we were kids, a Swiss bank account meant, or a Cayman Islands bank account meant, it was secret and nobody would ever find out about it. Well, what happened is after 9/11, the U.S. government strong-armed all these countries, strong-armed all these banks, and now there are no secret bank accounts for Americans anywhere in the world.
Yeah, a lot of stuff has changed since 9/11.
Because this is the home of the brave and the land of the Home of the brave? Land of the free?
Yes,
Something
okay.
like that.
Number 10, guessing on your investments on your Schedule D. Quick,
Okay,
Schedule
so,
D. What do
so
you
if
mean
you
by
have
that?
stock, if you have stock accounts, okay, the profits for those, or the losses for those stock accounts when you buy, or really when you sell, you have to report that on a Schedule D. Now, you have to have really specific information for each stock trade. So this is a nightmare if you're a day trader. It really is.
Oh my gosh.
It's a nightmare because you have to know the
Their
purchase
Schedule D
date.
is like 25 pages long.
I've had them hundreds of pages. So you need to know the purchase date. You need to know the value on the purchase date. So what you paid for it. Then you need to know the sale date, and then what the value was on the sale date. And then you have to determine the profit was the plus or minus of whatever happened. And here's what people
That
do.
gives me a headache just thinking about
Here's what
that.
happens is people buy 1,000 shares of GE, and then they sell 200 shares, and then they buy 300 shares, and then they
Yes.
sell 400 shares, and then they buy 300
gotta
shares.
keep track of
You
all
gotta keep
that.
track of all that.
Wow.
Okay? If you're guessing on your Schedule D, there's a very good chance you're going to be audited because
Ouch.
the IRS does have some of these records. Or if the position that you've taken just looks like it was a miracle that you didn't have to pay any tax, or
don't like
a
it.
miracle that you had these huge losses, they're going to
Uh-huh.
probably ask you what's going on.
All right, number 11, you guys get popped for this one a lot, unreasonable mileage.
Yeah, this is really, really common. So the IRS wants you to have a contemporaneous mileage log. What does that mean? Well, it used to mean a coffee stain, like little notebook that you kept in the pickup truck if you're a construction worker, and it was written in blue ink sometimes and black ink sometimes, and there was coffee stains and ketchup stains, and it obviously was a year old and that kind of thing. Nowadays, what we'd like to see is we'd like you to see you use a smartphone app like Mile IQ. There's a couple others where it literally tracks every single trip you take in a car, and some are going to be business use, and some are going to be personal. There's lots of mistakes that I see on mileage or car truck expenses, on mileage in particular, and they would be things like, you're just taking too many miles for what you do.
Yeah, they're looking, it's all relative to what you put your profession as at the bottom of that return.
So we talked about in the beginning, before the show, you're a real estate agent, you're going to have a lot more mileage allowance than a lawyer, for example.
Or
Now,
Pat.
some lawyers go to court every day, and they have to go to different counties, and they drive a lot. And some lawyers, like me, pretty much go to the office, which is not deductible,
Right.
and they sit there.
And see, for me, I have a totally separate car that I use for work than I do for personal.
Which is fabulous. So here's one last tip on this. Keep the service records on that car.
Got them all.
Because if you keep the service records, then you'll be able to prove that at least that gross amount of miles went on the car during the year in question.
I use Shoebox. I love it. All that stuff goes in the magic blue envelope at the end of the month. This was a great show, Darrin.
I think so.
It'll be on a podcast if you missed any part of it. Check it out. We'll be here same time, same place next week. This is the IRS Solution Attorney Show.
For today, we're out.